Okay, so let's talk about the latest jobs report, because it's created this huge puzzle in the economy. On the surface, the numbers look pretty great, but once you start digging in, even just a little bit, you find this really strange, kind of paradoxical story. So let's get right into it.
So this is the headline number that got everybody talking. The unemployment rate actually dropping to 4.4%. Now normally, that's fantastic news, right? It's the kind of thing that suggests a really healthy, growing economy. But, well, this time, the story just isn't that simple. And that brings us to the big mystery here. If the job market is so strong, why do we have so many other economic signals flashing yellow or, even red? We're going to unpack that disconnect because the real story is way more interesting than just that one headline.
All right, so to solve this puzzle, we have to look past the obvious stuff. The answer isn't that there's some huge boom in hiring. No, it's actually about what isn't happening.
And here is the absolute crucial point. The job market looks strong not because companies are hiring like crazy. In fact, hiring has slowed down. It looks strong because companies have, for the most part, just stopped firing people. So if you have a job, you're probably keeping it.
And this chart shows you exactly what I mean. It shows initial jobless claims. That's just the number of people filing for unemployment for the very first time. As you can see, the current number is way below that dotted line, which is the historical threshold for a recession. Put simply, layoffs just aren't happening at a worrying pace.
Which leads to the key question, right? If hiring is slowing down and there are all these other warning signs popping up, why are businesses so hesitant to make cuts? Well, the answer isn't really in the labor market at all. It's in the stock market.
And here's the core idea. When the stock market is hitting all-time highs, it gives company executives this massive boost of confidence. I mean, think about it. When your company's stock is flying high, you feel a lot less pressure to make those painful cuts to your staff. The market's performance is basically creating what you could call a layoff lockdown. And that's what's preventing the unemployment rate from spiking even while the rest of the economy seems to be slowing down.
Now, let's just take a second to talk about how unusual this all is, because what we're seeing right now isn't just some minor quirk in the data. It is a truly historic disconnect that has basically turned the normal relationship between the markets and the economy completely on its head.
This slide really lays out the paradox perfectly. On one side, you've got the stock market pushing to new records, just going up and up. And on the other, you have job openings, which are consistently falling. Now, normally, these two things move together. A confident stock market usually means companies are posting more jobs, but not this time.
And get this, as far as the data goes, this is the only time in recorded history that we've seen the stock market soaring to all-time highs while job openings are falling. One of these trends has to be wrong, right? For now, they're just telling two completely different, conflicting stories about where the economy is headed.
So we've got this layoff lockdown, keeping the headline number looking good. But does that mean the job market is actually healthy? Not so fast. Let's look at some of the cracks that are starting to appear just beneath the surface. First up, this number. For the first time in 3 years, the number of job openings for every single unemployed person has fallen below 1. And this is a really critical threshold. It means there are now officially more people looking for work than there are jobs available. That fundamentally shifts the balance of power in the job market.
So who's feeling this shift the most? Well, take a look at youth unemployment. The rate has just surged from 6.6% to 10.6% in a little over a year. This tells us that while a lot of experienced workers are holding on to their jobs, it's getting a lot harder for new graduates to get their foot in the door.
And finally, here's a classic leading indicator: temporary hiring. Think about it. Companies use temps when they're feeling optimistic, but maybe not ready to commit to a full-time hire. And temps are also the very first people to be let go when things get uncertain. So this steady downward trend, it's a pretty clear signal that businesses are getting more and more cautious. So we've got this strange, really paradoxical economy. What in the world does that mean for your portfolio? Well, different assets are reacting in very different ways, and it's creating a pretty fascinating investment landscape.
Okay, let's break it down. Stocks are just climbing that classic wall of worry. They're being powered by the very same executive confidence that's preventing all the layoffs. Crypto, on the other hand, is kind of struggling. It's a risk-on asset, so it really needs the Fed to start loosening monetary policy, and this jobs report doesn't really help that case. And then you have metals, which are off in their own bull market, basically thriving on all this underlying economic uncertainty. So the key takeaways are really this. The stock market is caught in this weird feedback loop where its own strength is propping up the labor market. Crypto is kind of sitting on the sidelines, waiting for a clear green light for rate cuts. And metals are benefiting from all the confusion. The biggest lesson here? You don't have to be married to just one asset. Like the old saying goes, there is always a bull market somewhere.
And all of this leaves us with the one defining question. The real economy is showing clear signs of slowing down, while the financial markets are betting on a much brighter future. This historic disconnect, it can't last forever. Something has to give. The big question is, which story will ultimately turn out to be the right one?